Hey folks, Dan Frio here, the Mortgage Update, and I figured I would do an alert to everybody to kind of explain what's going on. I'm starting to get a lot of texts and emails from clients that the Federal Reserve just made some moves, and so let me explain kind of what's going on. What the Federal Reserve just came out with right now is great news for the economy in general, plus phenomenal news for mortgage rates, and I'll explain that in a second. Most of you that might be watching this for the first time or don't deal with me directly, you're going to say, well, mortgage rates were already at a historic low. How's this going to make it any better? So first of all, what the Federal Reserve just came out and did was basically took the federal funds rate down to zero. We're going to unpack that in a minute. They're also going to jump into the markets and buy Treasury bonds, and I'll unpack that in a minute. And then one of the biggest things that they're going to do for the mortgage business right now is they're going to start buying mortgage-backed securities. And that's the focus of what I try to go through and explain every day. So basically effective March 16th, which is Monday, the FOMC is going to come out and start buying treasuries. It says right here, so Treasury securities and agency mortgage-backed securities by at least $500 billion in treasuries and $200 billion in mortgage-backed securities. Okay, so let's unpack it. What is a treasury bill or treasury bond or those investments? That is basically when the government needs money, they issue treasury bills or bonds or notes, and they issue those as bonds, and then investors buy them, and thus the money goes to the federal government. So they're doing that. They're starting that right now. What are mortgage-backed securities? And right now I'm going to go show you a quick little video basically what that explains.
Mortgage-backed securities, or MBS, are a type of bond representing an investment in a pool of real estate loans. To understand what a mortgage-backed security is, we need to go over what happens when a bank issues a mortgage. Let's look at how a mortgage becomes an MBS. Tony wants to buy a house costing $500,000. Usually, Tony would go to his bank and apply for a mortgage for $500,000. And in return for loaning this money, the bank would make Tony pay interest on the loan at, say, 8%. Before the world of mortgage-backed securities, the bank would simply keep this loan on its books and receive principal and interest for the duration of the loan, say 30 years. One downside of this arrangement was that the bank had to keep this loan for 30 years, tying up capital and resources. One day, the bank had an idea. It could sell the stream of interest, the 8%, and principal payments from Tony's loan to investors to get it off the bank's books and free up capital at the same time. The bank would make money simply from originating and servicing the mortgages and from other associated fees. In order to sell the interest streams to investors, the bank bundles Tony's loan together with hundreds, maybe even thousands, of other mortgages. Then the bundle of mortgages is sold to an investment bank in the form of a single bond. The investment bank partitions the pool of loans according to quality and sells the sections to other investors. So although Tony makes payments to his bank, the loan is actually in the hands of investors. Mortgage-backed securities are essentially a way for banks to free up capital and provide a way for investors to buy into mortgages.
Okay, so now I hope you have an understanding of mortgage-backed securities, and that is right through here. And you can just go to Google mortgage-backed securities, and then find the Investopedia or whatever you need for that portion of that. So basically that explains that. So basically mortgage-backed securities, that is the instrument that controls mortgage rates. It's not the U.S. Treasuries. It's not the 10-year notes, the 30-year notes. People monitor those, and they normally have a correlation with what's going on with mortgage-backed securities, but they're not the investment or the controlling factor of what's happening with mortgage-backed securities. So let's unpack. We unpacked what treasuries are, what mortgage-backed securities are. Now let's get on to mortgage rates. Okay. So basically, here's what happened last week in the mortgage-backed securities market. So if you follow me, and I hope you start doing, if you haven't, I hope you start doing now, and this is why. Here is what we follow on a day-to-day basis on my channel. I follow the mortgage-backed securities market. This number right here indicates the price. What is going on with the price of the bond that is mortgage-backed securities? As this price, why we watch this? Well, as this price goes up in value, means you're paying more for that bond. If you're paying more for an investment, it means you're getting a lower rate of return, a lower yield, a lower mortgage rate. We love when the rates are going, or the prices are going up. Look at these charts that we've had over the last several months. And this is where you're seeing, mortgage rates are at an all-time low. Okay? Right here, there was an anomaly that happened. Basically, last Monday, mortgage-backed securities, this number opened up 80 points, 80. That was the biggest one moment move I've ever seen in my 30 years of doing this. Okay? So it opened up 80 points right in here. And I'm going to explain these lines to you also. But it opened up at 80, up 80. Within minutes, it went back down to 0. On my side of the fence, I see this as a reversal in the charts. So I locked probably about $16 million worth of business right there. And it was perfect timing. And I wish I wasn't perfectly right, but I was right. Ever since that, prices have went down, pushing rates up big. So since Monday, we were locking rates in the high 2s. By the end of the week, rates were in the mid to high 3s. That's how big of a move this is. So the government is now coming in, or the FOMC is coming in and starting to buy back mortgage-backed securities, thus trying to create more of a demand for this to stagnate this rapid increase in rates. What was happening is people were starting to fear everything, and the banks were starting to fear a run on the banks. And the reason why the banks started to fear this is that at the end of each day, they have to have a certain amount of money in reserves, because part of the Dodd-Frank bill requires that they have X amount of money set aside in their account each night. Okay, it's like you having a checking account, and let's say to have that checking account open and active, you have to have $500 in it at the end of every day. Well, if you don't have $500 at the end of the day, you got to do something, or they're going to close your account immediately. Think of that. So you go out and beg, borrow, and steal money to put in that account so the account stays active. Well, what the banks do is they go to other banks and borrow money to make it have enough money in their reserves. Okay? So normally what happens is they'll just pledge something, like pawning something, and say, okay, you take these Treasury bills that we have and just hold them overnight. And then tomorrow when we open up, we'll take deposits and we'll do some other things, and we'll have enough money to get through another day. Well, the problem is now nobody's wanting to take those pledges. Another bank isn't looking to take those pledges. They don't want just a note. They want something solid. Well, what's happening is the banks are now forced to sell stuff to make themselves liquid. I hope that makes sense to you. Because the other bank giving them the money to meet their reserves overnight isn't comfortable holding a Treasury note or a mortgage-backed security, because the prices are deteriorating so much in value that they're like, no, we don't want that. You're going to have to make yourself liquid. So what the banks are now forced to do is they're going out and selling treasuries and selling mortgage-backed securities. Well, the bad thing is that is driving down demand and increasing supply. So if you have more supply than you have demand, to get to equilibrium, the price has to change. And what's happening is the price is dropping and dropping and dropping and dropping. And that is now pushing, again, when we go back for a second, as prices go down, rates are going up. So as banks and all investment companies are selling all these bonds, Treasury bonds, mortgage-backed securities, there's not much demand for it as well. You're having a crash of the market. So You hear in the news, mortgage rates are at all-time lows. Yeah, they were. They were last Monday. They are not by Friday. They're back to where we were about a month ago. So now the government is fearing. They're saying, okay, everything is bad. So we're going to step in and we're going to start to put an equilibrium in the markets. We're going to try to stabilize this. That's good, because those that missed out on this, historic low rates, are we going to get back there? I don't know. I see us getting back in here in a very good range. So this is going to give more and more and more people the opportunity to refinance again who might have missed the all-time low, but still get a phenomenal mortgage rate. So again, let's unpack this. The FOMC is coming in and buying treasuries to stabilize that market. They're also stepping in and buying mortgage-backed securities to stabilize this market so we don't have a deterioration. My clients, we locked probably you in right in here. If we didn't lock you in, is because you weren't ready and we didn't have, you basically didn't give us the go-ahead to move forward. So I have a lot of people on the fence right now saying, Dan, where are we? Dan, where are we? I'm like, you missed it. The good news is probably in the next 2-3 days, we should stabilize and get back into this range. Will we hit here? I don't know. I hope so, because we were locking 30-year rates in the high twos. But I can't predict the future. But basically, I just wanted to get an alert out there and say the FOMC stepped in. Yes, they drove down the federal funds rate. Now let's go over the federal funds rate. What is that? So the federal funds rate is the rate that it charges bank-to-bank lending. Again, what that is when the bank needs money overnight, they go to another bank and get money lent to them at a rate of return or an interest rate, and that is the federal funds rate. The federal funds rate and the Federal Reserve have nothing to do, zero to do, with mortgage rates. That is the mortgage-backed securities market. So again, you have three components here. You have the U.S. Treasuries, you have mortgage-backed securities. Those are the two things that the statement came out and said that they're going to start buying to put in a floor and create demand for those. And then you have the federal funds rate that the Federal Reserve just stepped in and made zero. Brought it down to zero. Again, that your mortgage rates aren't going to be zero because it is not controlled by the Federal Reserve, nor is it a part of the federal funds rate. It is interbank lending, so banks lending from each other. And basically, I wish we got that kind of deal to get money at 0%, but we don't. So the easiest way to check this out as well is look up federal funds rate, the definition of it. Tomorrow when I'm at my office, I'm going to do I'll walk you through all these components on a whiteboard to kind of make it make more sense to you, and I'll send out an alert on what rates or what mortgage rates are doing at the time. Hopefully we don't continue this crash, which we shouldn't, because of the FOMC stepping in, buying $200 billion worth of business. So I'm sorry this is a little sporadic. I just got the news. This was just posted, went live. I got updates, and I figured I would reach out to people before everybody starts just clobbering me on text, phone calls, and emails. So stay tuned for tomorrow. I'll give you a more definite detail of what's going on, how this will truly affect the markets, and I'll give you an update on where the markets are. Take care. Talk to you tomorrow.